Every Australian finance forum says the same thing. Build a VAS and VGS portfolio, set it, forget it, and let the market do the work. It has been the gold standard of simple investing for years. But here's the question nobody wants to ask. Does it still hold up in 2026? This two-fund combo has built genuine wealth for thousands of ordinary Australians. It's cheap, it's diversified, and it has a track record to prove it. This is not a hit piece, but markets change, interest rates change, currencies move, and an entire year has just gone past that looks nothing like the years before it. So stick around, because the numbers tell a story that a lot of investors have not seen yet. And by the end, the central question will not be whether this portfolio is good. It will be whether it is still built for the market Australians are actually investing in right now. Let's start with what this combo actually is. VAS is the Vanguard Australian Shares Index ETF. It tracks the S&P ASX 300, giving exposure to roughly 300 of the largest companies listed on the Australian Securities Exchange, weighted heavily toward banks and miners, names like BHP Group, Commonwealth Bank, Westpac, National Australia Bank, and Rio Tinto. VGS is the Vanguard MSCI Index International Shares ETF. It tracks global developed markets outside Australia, and today that means a portfolio absolutely dominated by the United States, which makes up almost 74% of the fund, led by names like NVIDIA, Apple, Alphabet, and Microsoft. Put them together and the logic is simple. VAS gives franking credits, dividend income, and exposure to the local economy. VGS gives exposure to the world's biggest growth companies and currency diversification. Management fees are tiny, 0.07% a year for VAS, 0.18% for VGS. No stock picking, no guesswork, no emotional trading. Just buy the market, hold it, and let time do the heavy lifting. That is exactly why this combination became the default recommendation across Australian investing communities for the better part of a decade. Now let's look at the numbers, because this is where things get interesting. As at the end of May 2026, VAS delivered a total return of 7.01% over the past year, 10.94% per year annualized over 3 years, and 7.92% per year over 5 years. VGS, on the other hand, returned 14.19% over the past year, a massive 17.82% per year over 3 years, and 13.77% per year over 5 years. Blend those two together in a rough 50-50 mix, and the combo has been generating a blended annual return somewhere around 10 to 11% over 1 year, and closer to 14% per year over the past 3. A genuinely strong outcome by any historical standard. Zoom out to 5 years, and the story looks even more impressive. A blended VAS and VGS portfolio has been compounding at roughly 11% per year on average, comfortably ahead of inflation, and streets ahead of leaving cash sitting in a savings account. For half a decade, this was, by almost any measure, a winning formula. It rewarded patience, it rewarded low fees, and it rewarded investors who simply refused to overthink things. But the 5-year average hides something the 12-month figure exposes. VGS has not just outperformed VAS, it has nearly doubled it over the past year alone. That is not the kind of gap this combo usually produces, and it is worth asking why. But here's the twist. Look closer at that gap between the two funds. VGS has been doing almost twice the heavy lifting of VAS over the past year. And that's not a coincidence. It's the result of 3 specific things that changed underneath this portfolio, and almost nobody explains them properly. Thing number 1, interest rates. The Reserve Bank of Australia cut the cash rate 3 times through 2025, in February, May, and August, taking it from 4.35% down to 3.60%. That was the environment that fueled a lot of the optimism behind Australian shares. But by 2026, inflation proved stickier than expected, and the RBA reversed course entirely, hiking rates 3 times and pushing the cash rate straight back up to 4.35% by May. Every single 2025 rate cut reversed. That kind of whiplash punishes rate-sensitive sectors like banks and property trusts, which happen to make up a huge slice of VAS. Thing number 2, currency. The Australian dollar averaged around 64 US cents through 2025. By early 2026, it had appreciated roughly 10%, briefly touching highs above 72 US cents in May. Here's why that matters. VGS is unhedged, which means when the Aussie dollar strengthens against the US dollar, the AUD value of those American holdings gets quietly eroded, even while the underlying US shares are climbing. In other words, a rising Australian dollar has been acting like a hidden handbrake on VGS returns, and most investors have no idea it is even happening. Thing number 3, market leadership. The last few years rewarded a very narrow slice of the global market, enormous US technology companies riding an artificial intelligence boom. VGS captured that because of its heavy US weighting, but VAS, dominated by banks and miners, was never built to capture that kind of growth. Meanwhile, an entirely different asset was quietly doing something extraordinary in the background. Which brings up what this combo actually misses: gold. Over the 12 months to June 2026, the gold price surged from around $3,300 an ounce to around $4,000 an ounce, even briefly spiking above $5,500 intraday in late January, driven by inflation concerns, central bank buying, and a weaker US dollar. According to the World Gold Council, gold ranked among the best-performing major assets of the past year. Neither VAS nor VGS holds a single gram of it. This combo also has zero direct exposure to emerging markets, since VGS specifically excludes them, and virtually no allocation to bonds, cash, or listed infrastructure as a buffer against volatility. Diversified does not mean complete. It means an investor gets the bet the index makes, not necessarily the trade that is actually winning right now. So what does a better approach look like? Nobody's saying abandon the foundation. VAS and VGS still deserve to be the core, the 70 or 80% that anchors the whole strategy. The idea is a core and satellite structure, where the core stays steady and a smaller satellite sleeve gets tilted toward whatever the core is missing. One example, a growth-tilted satellite. Keep roughly 80% in the VAS and VGS core and add a smaller slice toward global technology or emerging markets exposure, capturing more of that concentrated growth story that VGS only partially reflects. Given how dominant US technology names have been, tilting further into that theme would have added meaningfully to returns over the past year, though of course that also means added concentration risk if leadership rotates elsewhere. The second example, an inflation and defensive tilted satellite. Same 80% core, but the remaining slice goes toward gold and short-duration bonds instead. Given gold's performance over the past 12 months, this version would likely have delivered a smoother ride and a real cushion during the sharp share market pullbacks that came with the RBA surprise rate hikes in early 2026. These are illustrative frameworks, not verified back-tested portfolios. The point is the direction, not a guaranteed number. Now, a reality check. This approach is not for everyone. It adds complexity, it adds another layer of decisions, and it requires actually monitoring what is happening in interest rates, currencies, and commodities, rather than just topping up the same two funds every payday. If someone wants true set-and-forget simplicity, VAS and VGS alone still does the job, and there is nothing wrong with that. Beginners, in particular, are usually better off nailing the basics first: regular contributions, low fees, and staying invested through volatility, before adding extra moving parts. But for investors who already have that foundation locked in, who track their portfolio a few times a year, and who are willing to put in a bit more effort, layering in a satellite sleeve can meaningfully change the outcome, particularly in a year like this one, where the macro environment shifted 3 times over. It is not about being cleverer than the market. It's about acknowledging that a two-fund portfolio was built for a specific set of conditions, and conditions do not stay fixed forever. So here's the verdict. VAS and VGS is not a bad portfolio. It's not broken. It simply reflects a very specific set of market conditions, and those conditions have already started to shift. A few practical takeaways. First, understand exactly what each fund in a portfolio does and does not cover, because most investors genuinely do not know their global fund excludes emerging markets. Second, keep an eye on currency movements, because an unhedged international fund is not immune to a strengthening Australian dollar. Third, consider whether a small, deliberate satellite allocation, whether that's gold, emerging markets, or something else entirely, might round out the gaps in a two-fund core. And fourth, revisit the strategy periodically, rather than assuming what worked 5 years ago will automatically keep working for the next 5. Because the real question was never whether this is a good portfolio. The real question is whether it's still built for the market that exists today, not the one it was designed for. And that's a question every single investor needs to keep asking, year after year.